So I'm supposed to talk about what I think banking looks like in 5 years. I put together a handful of slides, kind of cliche. I'm going to then jump into the sixth slide where I talk about what my vision is and roadmap and so on. And now I'm looking at a room full of about 150 people. Most, if not frankly, all of you are bank customers or at least consume banking products, realizing I have no fucking idea what banking's going to look like in 5 years. And I'm pretty sure if we go around the room, you'll tell me and each other what banking looks like in 5 years. I hope that's the case anyway, because the intention is banking in 5 years is hopefully going to look very different than it does today and more centered around people here. And so the idea of I'll just rip through the cliche slides because hardworking people put that together, but usual cliches. This is what traffic or transportation and taxi industry looked like in the 20th century. Here's what it looks like in the 21st. Not here in Vancouver, of course, but in Toronto and other more fortunate cities. Something that is relevant to this room, Blockbuster, Netflix, of course, Airbnb cliche, all the usual things you'd think about. This, however, is not a 21st century experience. It's not a 21st century solution. Going to what is called online banking, but realistically is a shitty online portal for a portion of what you really want to do. Sad excuse for digital experience. I can guarantee you in 5 years, that's not what it's going to look like. What it's actually going to look like, I and everyone else are really just guessing. I think that our mission here at Grow, and I think a lot of other exciting fintechs, whether it's Vancouver, Toronto, or anywhere else, we're trying to create something that makes sense for our consumers, similar to the idea of on-demand entertainment, transportation when you want it, transparency to accommodations, more fair pricing. That's the spirit of what I think real banking will look like in 5 years. So I could talk about, I think that rates are going to come down. I think fees will be largely eliminated. I think that convenience will be, tenfold what it is today. You'll be able to do banking at 4 a.m, sitting on your couch with no pants, eating nachos. All of those things are somewhat obvious, and I think a lot of people would talk about. I think what's more interesting is, what are the massive, massive pain points? I'm going to use this as an awesome customer feedback point. I'm going to cut off the 5-minute speech early and actually take, hopefully, some suggestions from people in the room. What do you hate most about banking? If you could pick what it'd look like in 5 years, what are your biggest complaints? I don't know if we have a mic out to people right now, or just shout it out. Having to go to the bank to get checks. So what checks. Yeah, good question. So what do you hate more, the checks or going to the bank? Going to the bank. Okay. So I like that, because that's fintech. That's digital banking. Not having to go anywhere, sitting on your couch, sitting at work, sitting right here at the back, listening to a boring guy talk about fintech and doing all your banking there. Checks are useless, they're obsolete, but that's not enough. It's truly on-demand banking whenever you want it. Any other big complaints?
$3 service charges.
Oh, wait, Rob here. Rob had his hand up.
Having to wait 48 hours to update a balance, a number.
So where does that happen? Because I shit on banking all the time, but that's...
TD Bank.
Okay.
Anyone here works at TD Bank, you got to fix that, man.
Actually, that's a good... Does anyone work for TD Bank or any of the big 5 banks here? No? You got one? Yeah.
Oh, Paul's nervous, standing right beside Rob and nervously put up his hand there.
Yeah. I should have asked that question before people started shitting on TD Bank.
Actually, TD already has one of the best digital banks.
You know,
and I don't work there.
Let's move on. We're moving on.
That's actually a really funny point. I would agree. I think TD has the best online banking experience. In spite of that, nearly 35% of our customers are TD Bank customers. So even the best is not good enough for people who really demand a lot more. So yes, you're right, but you're still very, very wrong.
And we had the $3 service fee charges down here.
Yeah, that's just complete bullshit. There's no reason why. There's a cost base that justifies that with a truly digital strategy, lack of brick and mortars, much more lean operating costs, fewer people. But more than just that, massive, massive, massive profit margins. I mean, as a point of reference, RBC last year, 2015, closed a net profit margin of over $10 billion, the first time any Canadian companies earned more than $10 billion. In a country with between 30 and 35 million people, In the US, tenfold the population, the biggest bank, the most profitable bank, made about 20 some odd million dollars or billion dollars. It's JP Morgan. Not 10 times the profit margin, but 2.5. It doesn't take a genius to figure out that we're massively overpaying for that shitty service right there. Now, there's a lot to be proud of as Canadians. Great brands, trustworthy brands. We know our banks. They navigated through some choppy waters, particularly not that many years ago in a financial crisis, but they haven't been servicing us well. Which is where I'm going to now play a bit of devil's advocate on the other side, a guilty former investment banker that still has a little bit of loyalty to Bay Street. I don't think in 5 years that logo on the top left is going to look that different for most people. So today, how many people here bank with one of the big 5 banks? I'm going to see, I would have expected 85%, because that's kind of representing the population. It looked like much more than that. So people here are more sellouts than the rest of Canada.
Yeah, Vancouver. Woo!
I'm guessing the rest bank with a credit union or a local credit union, one of the larger ones. Don't need hands, but I'm sure that's kind of by logic, or that's got to be the rest of the group here. I think in 5 years, that's not going to look very different. I think 90% of people will put up their hands for one of the big banks, and 10% will put up their hands for the other credit unions. I think what's most interesting is we trust our brands. They're familiar. We know them. They're regulated relatively well, maybe a little too much, and we're paying for some of that cost. But we know that brand. What's absolutely broken is the $3 fees, the 48 hours to get a balance updated. The experience and the products absolutely suck. There's a big difference between the brand and the technology that's creating the products. The second is broken, the first is not. And that's what I think real technology companies, Fintech included, should be spending their time on. We're making real products, we're making real services. They're suited to your lifestyle, they're on demand, they're priced like they should be, but we're not necessarily forcing everybody to ditch the names that they knew their parents, their grandparents, their great-grandparents have grown up dealing with and trusting. Some of the oldest and largest, most trustworthy companies in this country are banks. We can have the best of both worlds. We can have the security and reliability with much, much better service. And I think that we're big fans of that. We're actively partnering we recently announced a partnership with one of the largest credit unions in Canada, whole slew more coming out, where you're going to be able to go to the brands you know, not have to download 6 different apps in your phone and have to manage 6 different relationships. All the convenience of trustworthy brands, but not that shit. Yeah, so we're running out of time, I'm sure. Any other questions, or any questions, I guess? How are we capitalized? So we specifically. Equity or debt, or probably both, right? So like any other startup, bootstrap for some time, raise some money from angel investors across 2 rounds, 2 sort of seed rounds, mostly local investors. I guess the 2 most notable being... So equity capital, like any other company, funding our operating costs. We work with a number of different institutions to fund our debt capital, so the loans that we extend are effective. The capital is effectively sourced from a number of different institutions. We fall under this broad umbrella of what's sometimes called marketplace lending or peer-to-peer lending, in the sense that we have financial institution partners providing their balance sheet capital to take that off of our balance sheet. It gets a lot more complicated than that with some securitizations and the like. But at the end of the day, one of the things that's not broken around this is not only the brand, it's that cheap balance sheet. Money that we can't compete with. We work with a lot of these sorts of names to get that money in the door, cut out a number of the costs around it, so you end up not paying that sort of a fee.
Can I ask your opinion on peer-to-peer lending?
Sorry, the question was...
Peer-to-peer lending.
Yeah, so one would argue we're sort of in that world, in the sense that it's not always our capital. We work with other capital providers to extend the loans to our customers. I'll be the bit of the devil here. I don't think it's a great model. I think that true peer-to-peer lending is this idea that I need to borrow some money, somebody over here has got some money to lend, and there's a platform, a company in between that connects the 2 parties. The reality is lending is a complicated process. There's a regulatory process around it. Diversifying your risk is challenging. Meeting a number of the regulatory obligations around terrorist financing, the like. I don't know that it makes a lot of sense for people to be playing armchair loan officer. I think that getting exposure to the returns that these big guys get, that RBC's benefited from to create a $10 billion margin last year, that's great, but it probably doesn't make sense for me to pull up my computer and start being an armchair loan officer, really. So one of the things we do is we're actually working with a number of financial institutions that will offer an opportunity for regular real investors to invest in products like ETFs and mutual funds and structured credit funds that then turn around and purchase loans from companies like us. But you benefit from somebody in between, a professional money manager that really has your interests in heart. Still relatively low fee though.
Last question. Anyone?
Great presentation, but I have a question regarding the infrastructure of the banks, because I know for the financial institutions, their infrastructure is still coded in back in the day from hardware language. How do you come across like integrating with all those financial institutions out there?
Yeah, it's a good question. How do we integrate with legacy technology, largely outdated technology, when we're ourselves using real cutting edge technology? The short answer is we don't directly interact with their back-end technology. That's actually what they're looking for us to do to solve those problems. So there's some front-end integration to create a seamless user experience. Somebody going to CIB's website should not feel like they're bouncing around 8 times. But the reality is that's where we really put our magic to work, is our back-end, and remove it from theirs altogether. I think we ran out of time.
Thanks, Kevin.